Two people, same income, same city, same year, 2016. One buys a house, the other puts that same money into the stock market. Fast forward to June 2026, 10 years later. One of them has nearly 3 times more wealth than the other. And it's not the one most people would guess. Real estate feels safe. You can touch it, live in it, show it off. Stocks feel risky. Numbers on a screen. But feelings have nothing to do with math. And the math on this one will genuinely shock you. By the end of this video, you'll know exactly which one builds more wealth, which one most people choose for the wrong reasons, and what the wealthy actually do when they have to pick between the two. Here's why this debate never gets settled. People argue real estate versus stocks the same way they argue about sports teams. Emotionally. Personally. Based on what worked for their parents or their neighbor or one lucky investment they made. Ryan bought a house in 2016 for $320,000 in a mid-sized American city. Nathan took that same $320,000 and put it into a simple S&P 500 index fund. Same amount, same year. Same person could have made either choice. By June 2026, Ryan's house is worth approximately $480,000, based on national median home appreciation of around 4.3% per year over that decade. Sounds great. Nearly $160,000 in gains. But Nathan's index fund, based on actual S&P 500 performance over that same 10-year window, is now worth approximately $890,000. Same starting point. 10 years later, Nathan has $410,000 more. Now, before every real estate investor closes this video, hold on, because Ryan's number is missing something, and so is Nathan's. The real comparison hasn't started yet. Let's build Ryan's real picture. Every dollar in and every dollar out. He put down 20% on that $320,000 house. That's $64,000 out of pocket on day one. He financed the remaining $256,000 at a 30-year fixed mortgage. In 2016, average rates were around 3.65%. His monthly payment, principal and interest only, came to roughly $1,170 per month. Now here's what the real estate highlight reel always skips. Property taxes. In most American states, that runs between 1 and 1.5% of home value per year. On a $320,000 home, that's around $3,500 to $4,800 annually. Call it $400 per month. Home insurance. Average in 2026 for a mid-range home runs around $2,400 per year. That's $200 per month. Maintenance and repairs. The standard rule used by financial planners is 1% of home value per year. On Ryan's house, that's $3,200 in year one, rising as the home ages and appreciates. So Ryan's true monthly cost of owning that home, not the mortgage, the full cost, is closer to $2,000 per month. Over 10 years, he has paid out approximately $240,000 in total ownership costs on top of his down payment. His home is now worth $480,000. He still owes around $215,000 on the mortgage. His equity, what he actually owns, is roughly $265,000. Subtract the $64,000 down payment. Subtract $240,000 in 10 years of costs. His net financial position from this investment is approximately negative $39,000 before selling costs. Wait. Before you say it, yes, he also wasn't paying rent. We'll come back to that. It's important. But first, let's look at what real estate gets right. Leverage. This is the part that genuinely works in real estate's favor. Ryan didn't invest $320,000. He invested $64,000 and borrowed the rest. His $64,000 controlled a $320,000 asset. That leverage amplified his gains in a way stocks don't automatically offer. Stability. Real estate doesn't show you a number every day that goes up and down. For people who would panic sell during a market crash, that psychological buffer has real financial value. Rental income potential. If Ryan had rented out a room or turned it into a rental property entirely, the math flips significantly. A $320,000 property renting for $2,200 per month in 2026 generates real cash flow that changes everything. Now Nathan's side. And let's be equally honest here. Nathan put $320,000 into a simple S&P 500 index fund in 2016. He didn't pick stocks. He didn't time the market. He bought a fund that tracks the 500 largest American companies and left it alone. The S&P 500 from January 2016 to June 2026 delivered an annualized return of approximately 12.3%, including dividends reinvested. That's slightly above the long-term historical average of around 10 to 11%, driven by particularly strong performance between 2019 and 2021, and again in 2023 and 2024. Nathan's $320,000 grew to approximately $1,020,000 by June 2026, over $1 million, from one decision: no tenants, no maintenance calls, no property tax bills, no insurance renewals. His ongoing costs, if he used a low-cost index fund like Vanguard or Fidelity, were around 0.03 to 0.05% per year in expense ratios. On a $320,000 investment, that's under $200 per year total. Now here's the honest downside of stocks that most finance channels skip. Volatility is real. In 2022, the S&P 500 dropped 19.4% in a single year. Nathan's portfolio on paper lost nearly $200,000 of value in 12 months. Most people, and this is not a small number, sell during moments like that. They lock in losses and miss the recovery. If Nathan had sold in late 2022, his story ends very differently. Taxes on gains. When Nathan sells, he pays capital gains tax. Long-term capital gains rates in 2026 are 0, 15, or 20%, depending on income. On a $700,000 gain, he could owe anywhere from $0 to $140,000 to the IRS, depending on his tax situation. No leverage by default. Nathan put in $320,000 and controlled $320,000 worth of assets. Ryan put in $64,000 and controlled $320,000. That difference matters more than most people realize. Now let's run the comparison that actually matters. Apples to apples. Ryan invested $64,000 out of pocket and paid $240,000 over 10 years. Total money deployed, $304,000. His net equity today, $265,000. Net return on money actually spent, negative. But if Ryan was renting before and would have paid $1,800 per month in rent over those 10 years, that's $216,000 in rent he didn't pay. Add that back. Now his real net position becomes approximately $177,000 positive, and he still owns the asset. Nathan invested $320,000 up front, 5 times more cash on day one. He paid almost nothing ongoing. His portfolio is worth just over $1 million today. Net gain, approximately $700,000. But Nathan also paid rent this whole time. If he rented at that same $1,800 per month for 10 years, that's $216,000 out of his pocket that built zero equity. Adjusted for rent, Nathan's real net position, gains minus rent paid, is approximately $484,000. Ryan's adjusted net position, equity plus rent saved, is approximately $177,000. Nathan is ahead by roughly $307,000 over 10 years, even after accounting for the rent Ryan avoided paying. Now here's where it gets complicated. Ryan used leverage. He controlled $320,000 with only $64,000. If we apply that same leverage to Nathan, meaning Nathan borrows to invest, his numbers change dramatically. But most people don't borrow to invest in stocks. The risk profile is completely different, and margin calls during downturns can be devastating. The fair comparison is this. If you have $64,000 to invest, and you're choosing between a down payment and an index fund, the stock market has significantly outperformed residential real estate in the last decade on a pure return basis. If you have a property that generates rental income, the entire equation changes. Cash flowing real estate is a different asset class entirely. And in many markets, it genuinely competes with or beats the stock market. So which one actually builds more wealth? Narrator. Here's the honest answer, and it's the one nobody wants to hear. It depends on one thing: what you'll actually do with the money. If you're the kind of person who would panic sell stocks during a crash, and most people are, then real estate's forced holding and psychological stability is worth more than any spreadsheet comparison shows. If you're disciplined, if you won't touch the money, if you understand that down years are part of the process, the data from the last decade and the last 50 years consistently shows that a simple low-cost index fund outperforms average residential real estate as a pure investment. Ryan represents most Americans. A home is their single largest asset. It builds wealth slowly, inconsistently, and with high ongoing costs. But it also provides shelter, stability, community, and an asset they won't abandon during a crisis. Nathan represents what the math recommends, but what very few people emotionally execute correctly. The wealthy, when you actually study their portfolios, rarely choose one. They use real estate for cash flow and leverage. They use stocks for long-term compounding. They don't debate which one wins. They understand what each one does, and they use both deliberately. The question was never really stocks versus real estate. The real question is, what is your money actually doing right now? And is it working as hard as it should be? Because in June 2026, with inflation running at 3.1% and the average savings account still paying under 1%, doing nothing is the most expensive decision of all. If this changed how you think about your money, subscribe. Because every video on this channel is built around one thing: the math most people never run. We're breaking down the one retirement account that lets your money grow tax-free, withdraw tax-free, and invest tax-free. And most Americans have never even opened one.